Do you need to pay tax on savings interest? If so, how do you do it? And more crucially, how do you protect yourself so you can pay less tax legally and morally through legit government schemes? I'm Martin Lewis from MoneySavingExpert.com, and this is my savings briefing. So the first question, do you actually pay tax on savings? Well, the answer is yes and no. You don't pay tax on the amount of savings you have, but you are eligible to pay tax on the interest that the savings earn you each year. That's a crucial thing. Savings tax is all about the interest, because the interest paid is a form of earnings, just like going out to work and earning is. Now, I'm going to split this into two categories. The first category is for those who are already taxpayers. You're a basic or a higher rate taxpayer. You're going out to work. Your income is already taxed. Later on, I'm going to talk about non-taxpayers and lower earners, because there are special things for them. But talking about those people who are generally paying tax, the most important thing to understand is you will probably have a personal savings allowance. This is a special amount of savings interest that you can earn each year, which isn't taxed. Now, if you're a basic rate taxpayer, a 20% rate taxpayer, which is generally someone earning between about 12.5 grand and £50,000 a year, then your personal savings allowance is £1,000. That means you can earn £1,000 of interest from any legitimate UK sources, and you do not have to pay tax on it. So your savings interest is untaxed. So let's do a little bit of basic maths. At the time of doing this, the top paying easy access account is around 5% interest. So how much would you have to have in there to earn a grand's worth of interest? About £20,000. So if you've got £20,000 or less in savings and you're a basic rate taxpayer, it is very unlikely that your savings interest would be taxed, so you don't have to pay anything, so you can get on with it. If you're a higher 40% rate taxpayer, which is someone earning over around £50,000 up to about 125 grand, then your personal savings allowance is £500 a year. So to earn that in that top easy access account, you probably would need to have more than £10,000 in savings. If you've got less, you probably don't pay tax. If you are a top rate taxpayer, so earning over £125,000 a year, you do not get a personal savings allowance. So all of your savings interest is taxed. Now, the next question before I come on to how you can prevent some of that taxation is, how do you pay it? Well, if you pay tax through the self-assessment system, so you're filling in a tax return each year, which you have to do if HMRC asks you to, then you would simply put the total amount of interest that you earn in your tax return. If you don't have a self-assessment return, which many people who are employed and in jobs and aren't very high earners don't have to do, well then, as long as you're earning less than £10,000 of interest a year, you don't really have to do anything, because the banks and building societies are feeding through your savings interest to HMRC, and it will automatically alter your tax code for you to take into account the tax on savings that you should be paying. So the next question, how do you protect yourself from that tax? Well, the biggest scheme and the most obvious one is a cash ISA, an individual savings account. A cash ISA is simply a savings account you don't pay tax on. You can put £20,000 in per tax year. Tax year starts on the 6th of April, ends on the 5th of April. Once you put the money inside a cash ISA, it's protected from tax. Now, there are lots of different types of cash ISAs, just like there are lots of different types of savings. There's easy access ones you can put your money in and out of. There's fixed ones. It's just a savings account in a special tax wrapper that you don't pay tax on. Now, the important thing about a cash ISA is you can put your money in, it's then protected from tax. So money in there, you don't pay tax on it, and it doesn't count towards the interest in the personal savings allowance. This is on top of that. As long as it stays inside the cash ISA. And you can put 20 grand in this year. Well, let's say you can then put 20 grand in the next tax year. So that's 40 grand. And then in the next tax year, so that's 60 grand. So if you were lucky enough to be able to max it out each year, you could protect more and more and more of your savings inside a cash ISA without having to pay tax on it. So for those who've got a good whack of savings, it's very worthwhile to look at a cash ISA because, well, as a 20% rate taxpayer, you'll be 20% of your interest would be taken away in tax if you're above the personal savings allowance. It won't in the cash ISA. Higher rate or top rate taxpayer, that's 40% of your interest or 45% of your interest that will be taken away. It won't be in the cash ISA. The other thing that you can look at that's very easy to do is premium bonds. The prizes that you earn from premium bonds are where you put your money away, the money you put in is safe, but you then get paid interest depending on a prize draw. And the prizes that you get from premium bonds are also tax-free. Now, I would always go for a cash ISA first. The rate on premium bonds, for most people, you will earn less in premium bonds than you would in a top cash ISA. But if you are going to be paying tax on your savings and you've got a decent whack you could put in premium bonds, then they could become a pretty interesting option for you. Not my first option, but an interesting option. Now, on both of those, cash ISAs and premium bonds, there's a full Best Buys guide to cash ISAs and normal savings on MoneySavingExpert.com. And there's a Is Our Premium Bonds Worth It article on MoneySavingExpert.com that you should read too. I'm not going to go into those today, but just saying that if you're going to be paying tax on savings, they're a worthwhile option. Now, I would like to move on to non-taxpayers or low earners who will pay a little bit of tax, because there are a couple of allowances you need to understand for savings tax as well. The first one is the general tax-free allowance. Most people in the UK can earn up to £12,570 a year from all sources, so from work, from other money coming in from savings, and you don't pay tax on it. So if your total earnings, savings and work, is below £12,570 a year, it's all tax-free. If you start to go a little bit above that, there is another special allowance just for savings interest for people on lower incomes. It's called the starting savings rate. Here's how the starting savings rate works. So you've got the £12,570 a year that you can earn tax-free from all sources. And then you have a £5,000 starting savings rate allowance. But for each £1 above your normal tax-free allowance that you earn from working, you lose £1 from your starting savings rate allowance. And here's how, let me give you a practical example. Let's say you earn £14,570 from work. That's £2,000 above the starting savings allowance. So you have the £5,000 allowance, but you lose £2,000 of it. So now you earn your £14,570, but you can only earn a further £3,000 from savings interest tax-free, not the whole £5,000 because you were £2,000 above the threshold. I hope that makes sense. But what this means in practice is you could earn up to £12,570 from working. You then have your £5,000 starting savings allowance from savings interest that would be tax-free. Plus, we talked about it earlier, the personal savings allowance, that £1,000 as a basic rate taxpayer. So if all of your money came from savings interest, you'd be able to earn £18,570 a year of interest tax-free. Now, I know that's a little bit complicated. My main aim in telling you in the video is just to say, if you're on a lower income, you need to understand the starting savings allowance. Do go and read the full article on that on MoneySavingExpert.com. Anyway, I hope that's given you the big picture of how savings, interest and tax works.